Let's now move on to get a global conversation going. Drew Pettit, Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi is with us. Drew, thanks so much for joining in. So there's, bonhomie in the air because the U.S. President and the Indian Prime Minister exchanging birthday greetings. More on that later. But I first want to start with the event at hand, and that's the Fed meet. So I guess everyone's saying 25 basis points is a given. But will that mean that these all-time highs continue for the U.S. market, even if data has started getting a little patchy of late?
That's funny. I think the last point you make there is the real key one here. Yeah, 25 basis points, as you've all said this morning, is completely expected by markets. Our house view is you are going to get some follow-through. You'll get 25 basis points here. And then 4 following meetings, you'll get 25 basis points of cuts. Market expects that. We should hear a relatively dovish tone, more cuts to come, more normalization. Yes. But how do we work the market higher from here? It's if the data holds in. A little bit of softness and normalization in labor data is okay for markets because there's secular trends driving earnings growth higher, especially in the United States and just growth in general globally. So if the data is okay and the Fed is cutting, that's a positive for equity markets and risk assets.
And Drew, okay, so I mean, a little bit of weakness in data you're saying is fine. The market will take it in its stride and we have rate cuts. On a side note, I'm just curious, what do you think and what are you hearing around the possibility of U.S. companies now reporting earnings only twice a year instead of quarterly? What's the chatter around that?
Yeah, look, still really early days. SEC is the one and that has to make the call here. At the end of the day, earnings season has not been a bad one for U.S. stocks, as long as they beat and raise, given the growth expectations are high. For us, it'll make conversations more important around what could be driving long-term growth if you're not reporting as frequently. But ultimately, earnings, whether I'm going to get them quarterly or every 6 months, if the projections are up and to the right and productivity is still a major trend in the United States, that's still good for risk assets.
Drew, just slightly, it's a question off the first point, which is the Fed cut, et cetera, 25 basis points is fully discounted. What are the chances with this big AI rally that we've had that if, markets sometimes need reasons to react and we kind of sort of tend to attribute reasons one way or the other, depending on what happens. But could this be the trigger for a bit of a pullback in the U.S.?
If it is a trigger for one, if it becomes a sell the news event, it's probably a healthy one. So markets should not just go up and to the right. We should have pause. We should have investors taking profits. That's a sign of a healthy bull market. If we are taking a breather, if there is a pullback because the news happened that was fully priced in, we think that's healthy. The really unhealthy kind of pullback would come if there's actually a dent in the earnings growth outlook, and we don't see that. So, yeah, technically, I'd agree with you. It could be a sell the news type of event because it's fully priced into markets. But if the earnings estimates are unchanged, and we get good reports for Q3 and good 2026 outlooks, it's a buying opportunity.
Hi, Drew. Good to see you. What about the Indian markets? The last I think I briefly remember was that you were, you're more neutral on emerging markets. So how you place between, emerging as well as developed markets? And where does India come into, your scheme of things? Because India has underperformed. The FI holding in the Indian markets is as multi-year lows. Your take?
Yeah, so it's interesting. We're underweight emerging markets overall as a global team here. And it's been interesting in the United States. From a dollar perspective, EM's outperformed, but from the flows from American investors, you couldn't tell. Investors have really stayed away from EM. So from a positioning perspective, we still like U.S. mega cap growth on one side of our barbell. On the other side of the barbell, we like cheaper value cyclicals, which we think you get in Europe, especially European financials. For EM specifically, we're neutral India. And here you have a reasonable growth story versus the rest of the EM, but the pricing is for better than average growth, so neutral there. In EM, where we like to lean right now is China and South Korea, because you have the secular story similar to what we talk about in US mega cap. So it's funny, regionally, you're not really getting a lot of alpha trying to trade EM versus DM and country versus country. Yeah, again, getting away from certain specific examples, but the alpha is really coming from sectors and themes. So when we think about regional allocations, we want growth, 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 paired with some cheaper value cyclicals.
All right. Drew, we'll leave it there. Thank you very much for joining us. Good speaking with you, and speak to you soon again. Appreciate it.
Hey, thank you, everyone.
That's the view coming in as far as Citi is concerned. We'll take a